Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Giles, I'm going to start with you. Well, for a couple of reasons. We missed you last week, and also we've got lots to talk about because we recorded last week's podcast before the ECB meeting due to the bank holidays. So we need to catch up on what happened last week, and also I think that it's been ECB speak over the last couple of days that's been driving markets. So let's start there. But first of all, quick recap of the ECB meeting last week. We had Gio on before the meeting, and he expected it to be a pretty, a kind of placeholder event with no real updated guidance. And obviously we didn't get any new forecasts. Was that what happened, or do you have any kind of updated thoughts on the ECB after the meeting?
Well, first things, I also missed all of you, to be honest with you. So the feeling there was mutual. And I think that Giovanni pretty much nailed it. It was not the most eventful meeting. And really, I think there's obviously a cacophony in the ECB at the moment. And that there was just not enough new information really for anything to be settled at this one. So what did we learn? Other than just to say not a great deal, there was quite a bit of emphasis on the potential for some kind of flexible response around protecting spreads and so on. Nothing specific about what that might mean. You could understand that perhaps as a hint that they are preparing some kind of new sort of quantitative easing, which isn't quantitative easing, sort of tool to try to protect spreads if need be, as they move away from this quantitative easing era to a higher rates, no quantitative easing era. I think that would be sensible, but they weren't giving anything away there. So that is it really. And then onto the ECB speakers that we've had since. I mean, to be honest with you, those have been a whole lot more colourful. And as you said, Imogen, very much driving the market, especially today. To the extent that I was forced to write something, just this morning, trying to bring people back to reality, because a couple of the people that we heard from this morning, and there is a sort of a sense of something building here, because we only seem to be hearing from hawks at the moment, and that's always it's often something which we remark. It's not so much that you expect to see people making big shifts, but when you have one side of the debate more silent, then that says something about who feels that they have the upper hand when it comes to the mood in the room. And maybe you might even go as far as to say that a quiet hawk is somebody who's reconsidering their position and that doesn't want to make a U-turn too quickly, because that would be indecent, right? So I think that that's the sort of mindset the market's in just at the moment. We heard from a guy, the Belgian central bank governor, who has been really pretty hawkish over the last few months anyway. He was ramping that up a little bit, talking about the possibility of positive policy rates this year, which, to be honest with you, is pretty much where the market is anyway. So, really just validating market. We also heard from the vice the vice president of the ECB, De Guindos, who, to be honest with you, I would never argue as somebody we should be paying all that much attention to, because he's a bit of a follower, I think, when it comes to monetary policy. He has other talents, I dare say, but leading the way in monetary policy thinking isn't necessarily one of them. Where does that all leave us? Same as before, just higher rates, to be honest with you. I mean, we now have 75 basis points priced in for this year, and then about 125 basis points for next year. So, that essentially means that we're looking at a July hike, probably September, December. That's the only way you really get there. As a October meeting as well. So maybe there's some interplay there. And then at some point next year, we're either talking about 50s or we're talking about back-to-back meetings. And that for next year, I wouldn't say that's impossible. I never would have done, but it does sound quite aggressive at the moment. So yeah, I think it's all built up as much as it can do for the moment.
So we've talked a lot on this podcast and in our notes for any of our listeners that read them, that both on the UK side and the European side, we think that, markets are pricing in too much really when it comes to central bank reaction functions. Like you say, on the European side, the market's now got 75 basis points basically priced in by the end of the year. And we only have probably a first hike in Q4, we think. So we think there's probably about 50 basis points there of rate hikes in the very near term that can be priced out. But how does the market, when does the market start to price those out? Because this is something we've been saying for a while, and the market seems to be shifting really in the other direction. So what are you looking out for in terms of thinking that this will kind of change the market's mind on when the ECB might go?
Listen, I think that one of the things that was reasonably interesting last week, we had the survey of professional forecasters, which the first time, actually I should check this, maybe certainly in a long time, the long-term inflation for sort of expectation of that community is slightly above 2%. So that's one of the things that I think that maybe worries the ECB a little bit. We've also had sort of medium short-term inflation expectations in the market. So things like 2-year inflation swaps rally by 100 basis points in the last 2 months. They're now sitting at about 2.7%. I mean, that's not going to reassure the ECB either. So I think that there is building pressure on the expectation side. But really what it comes down to, I think, is wages. We've been consistent on that, and we don't think that we're going to get the evidence on European wages until after the summer. So that is clearly in fact, that's probably the strongest reason why not to be talking about July rate hikes. The other one just being the uncertainty about how markets will sort of settle as quantitative easing stops. And if you raise rates in July and then go away on holiday, you're not there to sort of try to manage the market through communication and so on, which is traditionally been the ECB's style, and less so this ECB, I would say, but nonetheless, I think that's a consideration. I think that the probability of earlier hikes definitely increasing. I mean, compared to that expectation that you just described, Imogen, of which is still our base case of a December rate hike. I mean, I think that September and December, or something like that, is definitely increasing in probability. But 3 hikes this year, I think, is certainly still very aggressive. What the market seems to be looking for is this kind of Fed-style Damascene conversion to just full acceptance that inflation is not going away on its own. It's no use just hoping for it. You actually have to act. And as I said, I mean, they're probably looking, I think, for more evidence on the activity side, how the war will affect business expectations and so on. Will economic momentum and demand maintain this sort of reasonable momentum or not, and therefore how much do they have to try to restrain that in 2023 and beyond, and what evidence there is of more substantial second round effects, and that we think is a second half story.
Moving away from the ECB, just to finish up on the discussion on the European side then, because the other theme that I would say has been dominating our discussions over the past, 2 or 3 weeks has been around French elections. We obviously gave a short update on that last week, but since then we've had the debate last night between Macron and Le Pen, which was kind of pitched as the key event to watch between the first and the second rounds, obviously alongside the polls. What's your take, I guess, on the kind of main takeaways from that debate, and how that leaves you looking forward to the second round vote on Sunday then?
So I think both candidates actually did reasonably well. I think that Macron was, as expected, more solid on the hard stuff of policy, numbers, all that kind of thing. But I think that anyone who would consider themselves a Le Pen supporter probably didn't see anything that turns them off or turns them into an abstainer, or just fills them with apathy. I think that those who view Macron as just unbearably haughty and superior and so on probably comes away with their convictions there equally profound. So I think that the main thing to say is I don't think that there was anything in it. It was actually a little bit dry. So I think it's not likely to really bring out enthusiasm where it was lacking in the 1/3 of the French electorate that is a likely abstainer. I don't think it really shifts the needle that much, even on, well, I mean, there was one poll at least of Mélenchon voters who sounded like they saw Macron as the winner in this debate, and so that I suppose is important. But broadly speaking, I think that it was really for Le Pen to do the running, to maybe be a little bit bolder than she was. She was actually less sort of folksy and populist and sort of that, and more trying to defend her, and less on the attack actually as well, and more trying to defend and explain her own manifesto, which, to be honest with you, I think in these kinds of things, particularly sitting in her seat, that's probably not where you're going to win hearts and minds. And so I think that when you've got a nearly 10% spread to close, that you need to do more. And so I don't think she's done that.
Okay, that makes sense, and then I guess fits with the kind of market reaction that we've seen, well, since then, and also anyway over the last couple of days with the polls that have kind of been cementing Macron's lead. Okay,
so I'm going to turn this back on you now. I want to talk about the UK, because I mean we've had a very volatile week. I was away last week, and I mean just seeing the daily moves was really quite an eye opener, and I mean that's continued into this week. But there's been a fair amount of direction, and the UK has fully participated. We're now actually very close to the target that you set. What was it, 3 weeks ago for 10-year gilts? Now, how much further do you think that the market can realistically move?
Yeah, I mean, I think this week's been a tricky one because, like you say, it's been volatile, but the direction has generally been upwards fairly significantly, but on not much in the way of data and central bank speak. Well, we're recording this on Thursday, where we do have Bailey and Mann speaking, and then also this evening we get Powell and Lagarde, which we'll go on to talk about, Jan. So there is some central bank speak today, but other than that, for the UK, really, there hasn't been much data or much to really guide markets. So it's more like the UK has just been participating in this kind of global shift higher in yields. And as you say, we've now got close, although haven't quite touched, but got very close to it on Tuesday, 2% target in 10-year gilts. But I would say that I guess that target was partly predicated on a kind of domestic factor fair value model, which we've talked about in this podcast before, which came out with a fair value below 2%. But we were happy to suggest that yields could go even higher than that, given this kind of unrelenting global shift that we've seen in fixed income. But even there, I think there's scope for yields to, even if it's only temporary, go beyond this 2%, just until, front ends really price out this kind of very hawkish bank rate pricing that they currently have. We had 1.75 as fair value, but that was on our bank rate forecast of just an additional 25 basis point hikes this year. Whereas if you look at market pricing, they pretty much have one at every meeting, 125 basis point hike at every meeting for the rest of this year. So we're significantly more dovish than what the market is telling you. And it's really front ends that have been leading the way mostly. And so I think until we get that front end repricing that we've been expecting, you can expect longer end yields to drift higher as well. I guess to put that, to put some numbers onto that, if we put into our model, actual bank rate pricing in the market versus what we're expecting for bank rate over the next kind of 12 months, you get a yield target of 220 in gilts versus what we'd kind of said is 2% that we think is reasonable. And so roughly every 25 basis point hike that you get priced into the front end adds about half that, about 12 basis points onto 10-year yields. And until we, meaningfully reprice at the front end, I think that gilt yields further out can continue to rise upwards, perhaps not with the kind of speed and volatility that we've seen over the last couple of weeks, but I think there's probably still some momentum there.
Okay, so risk is still on the upside, and I mean that's also very much the way that we're thinking about European rates as well. Okay, so the other big thing on the horizon in the UK, I suppose, is this linker syndication next week. Oodles of duration coming in from that. I'd like to hear how you think the market's going to take that.
Yeah, it's quite interesting because I guess duration, in terms of looking at the whole year, it's going to be quite front loaded this quarter. We've got two syndications, both of which we expect to be at the very long end of the curve. So, we always think of syndications as being a kind of big duration event, but even bigger if they're coming at the very long end. We know obviously that we have this linker 73s coming up next week, but we also expect that the second syndication this quarter will be the nominal 73s, and that was pretty much consensus, I think, if you look at the minutes from the DMO consultation a couple of weeks ago. So, very front-loaded duration, and there'll be a lot for the market to absorb. But I think that actually, given, I guess, the dry spell that we've had in the UK in terms of the lack of duration that's been issued since pretty much the end of last year, there really hasn't been much linker issuance at all. Plus the fact that this year as a whole, the kind of total billions amount of linkers that we're going to get is pretty low, largely, by virtue of the fact that gilt supply is lower than expected. But that means that, in billions, the amount of linker supply we're going to get is the lowest that it's been for some time. Plus the fact that we've had kind of rising real yields, high funding ratios. If you look at, even a very long-term history, funding ratios are relatively high. And both of those kind of add up to de-risking demand for long-end linkers. So although it is set to be quite a kind of heavy quarter, I suppose, in terms of duration being front-loaded, I think that actually next week's supply event could be taken down pretty well. And we're already starting to see, just today, we're starting to see kind of strong demand for that kind of part of the curve. It's the long end that's been leading the flattening in terms of linkers, and also then in the nominal space as well. So I think that the market should be able to take this down quite well.
Okay, thank you very much, Imogen. I guess we move on to Jan, who's been sitting here very patiently to talk about the US.
Yes, last but not least, Jan. I guess I mentioned it before, but perhaps you've got the short straw this week again, like Gio had last week. I'm just quickly thinking about what we might get from Powell later on this afternoon. It's been a very quiet data week this week. It's been a shortened holiday week in Europe and the UK, so there hasn't been a huge amount going on with, apart from very volatile markets, but not much actually driving that specifically. So I think everyone's kind of been watching and waiting for this panel of Powell and Lagarde later on this afternoon. What are you really expecting? Markets are almost fully priced for a 50 basis point hike in May, largely expecting an announcement of QT following, the meeting and the minutes over the last couple of weeks. Is there anything he can do to kind of surprise markets in either direction, or will he just really reiterate what we've already heard?
Yeah, I think it's going to be tough for him to go out there and surprise the markets, and I wouldn't think that will be his intention as well. Pretty much markets are primed for 50 basis point hike at the next meeting and announcement of QT. There have been multiple articles in news outlets, which basically kind of soft confirm it as well. And as you'll remember, before the March meeting, Powell used a similar opportunity in front of Congress, where he basically locked in a 25 basis point hike. He more or less confirmed that the Fed's going to lift off in March, solidified expectations. And this also today's panel at the IMF with Lagarde comes right before they enter their blackout period after tomorrow, which means we're not going to get any more Fed officials commenting. So far what we have seen is Fed local presidents and board members, they'll come out, even the more dovish ones are saying that there's a strong case to be made for a 50 basis point hike. It's complete consensus amongst the FOMC, and it just would surprise me greatly to see anything besides those lines. I don't think we're going to get anything along the lines of hints at 75, like St. Louis's Bullard suggested. I don't think he's going to walk back to 50 either. And they're going to stick to this credible messaging method that they've used so far, and he's going to go out there and confirm what we already know. So with that in mind, it just feels it's going to be hard to out-hawk what the market has priced in. Like you said, market expects it. I think Powell's going to deliver.
Yeah, that makes sense. I guess we've already had, quite a big shift in terms of Fed rhetoric and how the market is pricing that in over the last couple of weeks. So to go even more hawkish than that would be a stretch. I guess then, what does this all mean kind of further out the curve for your rates for you? Because when we spoke last week, we noted that you'd gone neutral for the first time in a long time on US Treasuries, and you were just waiting for, this sell-off to go far enough that you thought that actually then Treasuries would be a buy. We've had a fairly significant move even since we recorded last week, and now you have published your recommendation for going long 10-year Treasuries. So can you just kind of talk our listeners through that and I guess how much you see the upside in that trade and when you might be looking to add as well?
Yeah. So we wrote a note, like you said, about going along the 10-year point of the curve. And let me start with why the 10-year, because originally our focus was more so concentrated on the 5-year, like the belly of the curve. But we just got this interesting bear steepening, which is pretty late all to see at this point in the cycle, particularly since we didn't have any data to refute that the economy is kind of lifting up, even though the Fed has tightened forward expectations. So with that in mind, it felt like a lot of that move was driven by unwinding of existing fairly consensus, I would say, flattener positions, and that comes amidst low liquidity in markets. So it really drove the 10-year part of the curve into attractive levels in our mind. And with that in mind, we recommended going long. That doesn't mean that we don't see the Fed's going to be hawkish. We do think they're going to maintain this stance of hawkishness. But once the market reaches a point of pricing to perfection in our mind, what we should expect at least in the next couple of weeks to next couple of months. So this is more so like a tactical trade. It's not our complete long-term view that the Fed's going to make a U-turn or anything like that. But it's just the idea that pricing is right. The narrative hasn't changed, but the pricing has caught up to it. And with that in mind, something has to give, and we think it's going to be the 10-year part of the curve, particularly if you have a lot more kind of commentary that underlines that the Fed has to go more aggressive, the Fed has to tighten more. Well, I mean, at some point, that is a bid for fixed income past the front end, because the more the Fed tightens the kind of like the tabs, the higher the chances for a hard landing, which is flatter curves and longer yields.
All right, that makes sense. So even though it's tactical, I would say that it's probably the first time you've been bullish rates for a...
Yeah, that's right. I mean, and it's kind of tough. That's why we suggested starting off with something like a 50% risk allocation. Then if say like yields snap up to above the 3% mark in 10 years, then we would be looking to add more, because we acknowledge that this move in rates has been pretty trendy and volatility is extremely high. So the position would be hard on to, or a lot of positions have been hard to hold on to, even if the fundamental view hasn't changed. They just tend to be kind of like painful moves in either direction, which can put you off sides, especially if you have tight risk limits. So we suggest kind of scaling into these longs as opposed to going like a full conviction buy and forget.
Yeah, yeah, we've been talking a lot here about how volatile markets have been and, well, how unrelentlessly volatile it feels. All right, then. Thank you both for joining me today. I think that's probably all we have time for. And thank you to our listeners. Just a reminder that if you liked today's episode, please don't forget to hit the like button and subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.